This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, I'm Oldfish. To be honest, just a year or two ago I was like many of you, a very firm index investor. I believed in long-termism. Buy the broad market, hold it tight, and wait for retirement. But as we all know, the living environment has changed in recent years. Prices are rising, mortgage rates are going up, and the emergence of AI has made our livelihoods feel precarious. I increasingly felt like I was losing control over my life. I started to realize that financial freedom in 20 years sounds great, but what I need more right now is a safety net that can support my family's expenses. So I made a major decision. I sold all my market cap weighted ETFs and converted my entire portfolio into what you see now, these high dividend assets that many people call high risk. But this isn't about getting rich quick. It's purely to cope with life right now. So today, let's talk about my little survival investment portfolio. Now, many people might think I'm gambling, but it's actually quite different. My portfolio still uses a core plus satellite strategy. First, let me introduce the core. This part is basically indices like HDIV and HYLD. This remains the heavyweight in my portfolio because their underlying logic is very clear. Essentially, they are the condensed version of TSX 60 plus the S&P 500. By strictly controlling sector weights, they ensure an extremely high correlation with broad-based indices. Simply put, although their holdings are selected, as long as the market goes up, they will follow. The characteristic of these two funds is a total covered call coverage ratio of 30%. That means sacrificing 30% of the upside potential in exchange for an annualized dividend of 10% to 12%. A low coverage ratio handles extreme market conditions better while still capturing higher upside. Over the past 2 years, these two funds have performed well, and they are constantly evolving. This year, adding SCHD, CHD, and QD increased the breadth of stock coverage, making it even closer to the TSX 60 and S&P 500. Meanwhile, the BMAX series has a lower covered call coverage ratio, increasing the efficiency of converting covered calls into cash flow. It is precisely their continuous evolution that gives me more confidence in holding them. So, I am still betting on the economic future of the US and Canada. I've just changed the way I hold them, converting the gains originally reflected in stock prices into cash in hand every month. Next is my tech core, QQCL and QD. QQCL corresponds to the covered call version of the Nasdaq 100 index. It is one of the few ETFs in my core portfolio with a covered call coverage ratio of 50%. With 50% coverage at extreme condition, even if writing out of the money call options, the strike price isn't far from the current stock price, which means sacrificing about 50% of the upside. Although I don't really like its strategy, it is the only covered call ETF in Canada that fully tracks the Nasdaq 100. Next is QD. Its underlying asset is XLK, tracking the technology sector of the S&P 500. It's not betting on a single company. It's buying the entire US tech industry. Personally, I firmly believe in the future of AI and technology, so I'm willing to give it core position status. QD uses a zero DTE strategy. Theoretically, the coverage is only 20%, meaning it can retain most of the upside. However, this ETF has a downside. It's expensive. My bet on it is based on the fund structure. I really look forward to its future performance. So for technology, I use QQCL to hold the Nasdaq and QD to bet on the tech sector. Now let's look at my satellite positions. First is the bank ETF. It tracks the Canadian Financial Sector Index and follows pure index logic. You might ask, since it's an index, why does it only make up 5% of my portfolio? This involves asset allocation. I set a rule for myself. My total exposure to Canada, including HDIV, must be strictly controlled between 20% and 25%. Although bank is a good ETF to adhere to my allocation ratio, I keep it strictly around 5%. Next, let's look at HHIS and BIGI. I treat them very cautiously because they carry obvious active management risks and concentration risks. For example, BIGI only holds 10 stocks, and HHIS is an enhanced ETF with a basket of stocks selected by fund managers. Although they can provide super high cash flow, like BIGI's semi-monthly payouts, I would absolutely not bet my life savings on a fund manager's personal stock picking ability. So I define them as satellites used to boost income. Finally, let's talk about another satellite position, perhaps the most controversial one, HBIX. This is a Bitcoin covered call ETF. Currently, I have a paper loss of 15%, but not only have I not sold, I'm actually buying more. Why? This is actually a strategy I've thought through deeply. I know that for a high volatility asset like Bitcoin, buying a covered call ETF is a bit of a disadvantage. Because if Bitcoin skyrockets, the covered call strategy will cap my upside, and even with 25% leverage, it might not make up for it. So why do I still buy it? Because what I value is the high dividends brought by its high volatility. If a volatile asset like Bitcoin didn't have dividends, I probably couldn't hold on to it. But I am bullish on Bitcoin in the long term. It is precisely the steady stream of high cash flow that gives me the confidence to hold it long term. Without dividends, if it dropped 20%, I might panic. But with dividends, I can not only hold on but even dare to add to my position during dips. For me, this is a strategy of sacrificing some potential upside in exchange for peace of mind. Although not perfect, with a position size of 5% to 10%, it suits me very well. So after saying all that, what are the results? I've been recording my dividend levels. Here is the current dividend forecast. The monthly dividend exceeds 2,500 Canadian dollars. What does this $2,000+ mean to me? It covers my mortgage plus monthly property taxes. This is the entire meaning of my transition. Previously, when holding indices, although the paper value was rising, I had to pay out of pocket every month for my real estate property. Now, the cash flow from my portfolio can support the mortgage for me. Since I still have income from my job, I reinvest this money. This also means that if I get laid off, I can look for a new job with much more composure. This gives me a lot more confidence. The old me thought risk was stock prices falling and accounts shrinking. But now I've discovered that risk isn't actually about volatility because in the long run, indices go up. Risk often comes from life changes or not being able to withstand volatility, causing you to make the wrong decision to sell your assets out of necessity. Perhaps mathematically, the long-term return of a pure index might be superior and the risk lower. But life is never a simple math formula. If you unfortunately lose your job or your family needs money, no matter how excellent the assets you hold are, you might have to painfully cut losses at the bottom. At that moment, what was just paper volatility becomes a real loss. I know there's always a chain of contempt in the investment circle, where many growth investors look down on covered call ETFs. But I believe current covered call ETFs are evolving too. They have leverage, more advanced strategies, and increasing efficiency. HDIV and HYLD are great examples. Of course, investing is a very personal matter. I made this video not to change anyone's mind, nor to persuade everyone to buy covered call ETFs. This is just a record of my own investment. I always believe that the essence of finance is to make people's lives better. These cash flow products can solve my anxiety and let me sleep soundly, so for me, they are the right products. Therefore, I believe there is no absolutely correct investment method, only the investment method that suits you best right now. I'm Old Fish. If you found this video helpful, please like, comment, and subscribe. See you next time.